Welcome to the Scholar Advising Podcast. Today we're answering 3 thoughtful questions from listeners navigating big financial decisions both for themselves and for people they care about. First up, if inflation isn't cooling down, should you adjust your plan or stay the course? And then we're going to talk about how you can encourage a friend or relative who's behind on building a strong financial foundation. And finally, we'll explore what to consider if you're thinking about impact investing, from definitions to performance myths to whether it fits in your portfolio. We'll cover the key questions to ask before diving in. In our From the Field segment, I'll also share a few quick takeaways from our annual personal finance conference in Charleston, and thank you to everyone who made it such a great event. Let's get into it. So the first question is, we created our financial plan assuming inflation would cool down. Should we rethink our numbers if it doesn't? So this is a big one. We're seeing this with this persistent inflation that continues even now. Most recent prints on inflation show that inflation has come down, but it's still above the 2% goal that the Fed would really be looking for and targeting. So that's starting to increase some worries out there, as you're saying, of what if this is more persistent? What if we're going to have inflation that's higher for longer? I'd say that because financial plans are built for such a long time horizon, the impact of even if we saw inflation be 2 to 3% for the next few years isn't likely to derail a financial plan, as long as we think that in the long term, over decades, we're expecting a 2% average inflation. That is what the historical Fed target is. Now, if you do agree that we're going to have this huge inflation, you say, no, if you're on that path, we're going to see 2 to 3%, maybe 4% forever, then we do need to make some changes, right? The first would be really to think about spending in a different way, of what things are going to be affected in your life by an increase and what things are not going to be affected in your life by an increase in inflation, and starting to narrow this down. Things like food, energy costs tend to move a lot closer to inflation, whereas home prices may increase with inflation, but if you already have a paid off home, that's not going to be as much of a concern. So starting to tease that out a little bit to see what the adjustment would be, and then starting to look back at what types of assets are going to do better in an inflationary environment. Now, we have to be careful here because certain assets do better in big inflation, things like real assets, but those aren't necessarily linked to you creating more income in your portfolio. So it's easy to say, go buy a bunch of gold and go buy real estate because you think inflation is going to be higher. The risk of that is gold doesn't produce any income for you in retirement. So it's really not solving a problem necessarily. Equities end up being a pretty good hedge against inflation because the prices of the equities are going to be related to the earnings, and earnings can be higher because the cost can be passed on to the consumer. And so you think about this as like a General Mills, right? If the price of corn goes up due to inflation, that price is passed down to consumers for cereal. So earnings then would be higher for General Mills, which means the price of General Mills goes up. So you have this whole relationship of this pass-through of income on a normal, just persistent higher inflation. The other one we always want to watch out for is lifestyle inflation. So maybe this is a good time to think about what things you're going to start increasing from a lifestyle inflation aspect and which things maybe you could cut back on to counter the effects of overall inflation as well. I think if I had to throw an opinion on this one, I would say that I think we do see inflation come back down to where it needs to be in historical averages, while the Fed has a lot of things going against it and has a lot of bad stories that go along with it. Over the long term, we tend to see inflation around that 2% number. And where we're at now at 2.5% isn't enough for me to worry. In fact, I take that as a good thing that at 2.5%, we're so close to the target that puts us in a good spot. And we're not at 10% like we were a few years ago. All right. The next question here, what advice or approach would you suggest to help a friend, relative who has not saved for retirement and has a low financial literacy, trying to make it simple but don't know where to start? This is a tough one. I think it hits everybody, especially a lot of our clients, because our clients are really good with their finances. The nature of working with DIY investors is that you're dealing with people who are handling their own money and they're comfortable with it. So they've gone through a lot of the basics. They've saved for retirement. They have a good emergency fund set up. So it ends up being really difficult for them, and it sounds like in your case as well, to see someone else who's not on that same path. All right. And it's this fine line that you're walking, right, of giving advice without becoming overbearing on it, right, and trying to keep it simple, or worse, seeming like you're kind of showing off with your finances, which is always that really tough spot to be in of, I'm really good with my finances, so you should listen to me because you're bad with your finances. That's not a great conversation to have with anyone. So general guidelines around that are ways that I've seen that go well. It's actually similar to how you handle talking to your children who are starting jobs and everything else, is that you're looking at this as a teaching moment without forcing it upon them, right? So just general conversation about retirement, or, hey, I was talking to my financial advisor and they had this, or I was at a finance conference and saw this type of thing, or I read this recently in the Wall Street Journal. Bringing up those types of conversations are great gateways to open up that conversation and them saying, oh, well, I've never thought about that, or we haven't planned for retirement, or we don't have anything saved. And then be able to jump from there into saying, well, if you haven't thought about it, you should, here's why. Or if you haven't thought about it, here's a good resource for you. So resources are always a good one. Fortunately, there's a lot of financial knowledge out there. I think that's probably one of the greatest things with the rise of technology and even social media. They got to be a little worried about what you're reading out there, seeing out there on social media. But it does show that the prevalence of financial information is huge. I mean, podcasts like this and newsletters and everything else are helpful. But book recommendations are always an easy one if they're a reader. It used to be that the recommended book was always A Random Walk Down Wall Street, which is a fantastic book, but it's a little technical, or can be a little technical, but it did a great job of kind of a all-encompassing, this is how you handle finance, right? These are investments and everything. So depending on who you're talking to, but from what it sounds like, if they haven't saved anything for retirement, low financial literacy, then a good place to start would be The Psychology of Money by Morgan Housel. Great option there. Really easy to read. It's not very technical. And then I would use A Random Walk Down Wall Street as book 2. When it comes to retirement planning, there's some really easy back of the envelope math that you can use. It's definitely a one size fits all approach, but we know in conversations we've had on podcasts and everything that the one size fits all approach typically fits no one. But if someone's in a situation where they have this low level of financial literacy, they have nothing planned, something like the 4% rule works really well. There, however much you have saved, multiply by 4%, that's how much you could withdraw from your accounts every year in perpetuity throughout retirement. That typically is roughly 25 times income is another way to think about that. So you would look at, let's say, for some rough examples, the friend or relative you're talking to has a need to spend $60,000 a year, right? And they're expecting $40,000 from Social Security. That means we have a deficit of $20,000 that they need to fill. In that case, using the 4% rule, that would say they need somewhere around $500,000 saved up for retirement. And just walking through an example that fast and that easy for them puts you in a place where you're not having to know their finances, which are always a personal topic there, but it gives them some really easy math to take home. And hopefully they look at it and start running their own calculations of what that looks like. Outside of the investment side, and this I guess depends on the level of financial literacy that's out there, even going back to the basics of, do they track their expenses? Do they know what their budget looks like? Do they have an emergency fund in place of a few months of expenses? Those are all low-hanging fruit there to discuss, but generally the conversation's more about retirement and them planning for retirement. And if you can throw those quick back-of-the-envelope calculations at them, I think that'll probably go a long way. And somehow throw a book recommendation in there, and you're probably going to put them on a good start, for sure. And let's go to the third question. So we're interested in impact investing. What do we need to consider when picking funds to add to our portfolio? All right, this is a huge question, right? This impact investing topic can go many different ways. And there's a lot of acronyms that get thrown around on this impact investing. So I think the idea here, if we take the 10,000 foot view on impact investing, is you want your money and investments to match your values, right? So you're looking at, what are you investing in? And you only want to invest in things that you believe are going to add more of an impact in different areas. Now, there's different ways to look at that. Typically, there's more inclusion lists. So you just put more of your money in different areas that you believe are doing good for the world or anything there. We typically see that more for charitable giving and foundations of, how do I donate $1,000 that's going to create $5,000 worth of good in the world? So we see that regularly. But when it's in your own personal investments, the ones that are popular around this impact investing idea are ESG and SRI. So SRI being socially responsible investing, ESG being environmental, social, and governance. Now, they're very similar in how they're structured. SRI is more on the socially responsible side of things, but ESG was the one that really took off. And I can't even say that it went back 10 years. I'd say maybe 6, 7 years has really been when that started to become a normal term being thrown around. Wall Street really got behind it on the ESG side. A lot of that had to do with any time there's a lot of people interested in a topic, Wall Street's going to get behind it because that means fund flows are huge, right? So they can come up with a fund that matches that theme, whatever it is. You're seeing this now with thematic investing as well, not only on social and governance type topics, but thematic investing around AI, right? Or we saw a few years ago more around renewable energy. And you'd have these different funds that would open up on a very targeted area and says, well, if you want to invest in renewable energy, we have a fund that focuses on solar plants and wind farms and everything around it. And you see the same thing with AI now. So that thematic investing, a subset of that would be into this ESG, SRI type of topics. Now, the problems with that and the way these funds usually work, and you, just like many funds, you have active funds, you have passive funds. Your active fund, somebody's going to be in there picking and choosing what are the best ESG friendly funds and excluding those that are not ESG friendly. The passive ones are going to have rules, right? So they're going to have certain rules that say if you rank high on an ESG list, then we're going to invest in you. But if you rank low on an ESG list, then we're not going to invest in you. And I hope what you're getting from that is that, well, do you need a list then, right? Who determines the list of what's high and low rankings for ESG? And that is exactly where the problem has been over the past few years on these funds, is that they're kind of arbitrary lists. We've seen this happen a lot. A good example of this was the big poster child for ESG movement a few years ago was Tesla, right? Reinventing electric cars, right? Going on making electric cars cool. So on some lists, they were ranked really high as this was the best ESG company you could get. And then other lists would look at different areas of the supply chain and say, well, there's a ton of mining that goes into creating the batteries for the electric cars. So if we encompass the entire supply chain, then Tesla's like at the bottom of the list for these. And then you would see things like Apple, who ranked really high on environmental or governance, right? But then when you took into account labor practices, they ranked really low on social. So you have these weird lists where depending on the index that's being used and what list is being created, some companies would rank high, some companies would rank low, which means then somebody would ask the question, which we'll talk about, well, what's the performance? Do you outperform the S&P 500 if you invest in an ESG fund? And the question is, well, what's your definition of ESG? Because companies are rolling in and out. I've seen really high ranked ESG ratings for ExxonMobil because of their investing back into different types of environmental causes and governance issues. And then I've seen others where they're the absolute worst company to invest in. The issue you run into is not only is there's this arbitrary calculation of what's included and what's not, but then you run to the other side, which is performance. And what normally happens is these ESG and SRI funds tend to overweight technology companies, and then they underweight energy companies. So in times where you have a bull market, like we've seen over the past 15 years or so, you end up seeing a big increase in ESG does fantastic because my ESG fund outperformed the S&P. Well, it's because you're overweight Apple and Tesla, Microsoft, Nvidia, all these different things. And you are underweight energy stocks, which do well in times the market drops because you're avoiding ExxonMobil or BP. Now, 2022 is a perfect example of this. 2022, markets have issues, inflation goes up, right? We see a lot of concerns there. Bond values drop, so people started to have a flight to quality, flight to more stability in their portfolios. So what did they buy? They buy utilities, they buy energy companies, they buy consumer staples. And if you were in an SRI fund or an ESG fund, you missed out on all of those really good energy returns because you weren't invested in Exxon or BP or any of these types of companies. So the question of what considerations to think about, I think when you're thinking about investing in this and putting these types of funds in your portfolio, it's worth doing the due diligence to make sure you know what you're investing in and what types of rules have they established for the fund. And then you also need to go in knowing that this is not a performance calculation, right? That you probably will underperform the market, and especially over the long term. But the question really comes down to, It's not a performance metric, it's a values metric. If it is really important to you that you're only invested in a certain amount of companies, then performance shouldn't bother you anyways. Your performance hit that you could take is just the cost of you aligning your values to your portfolio. So that's the way I would look at what to consider when you jump into the impact investing. We could talk on that all day long because, I mean, there's so much conflicting evidence on it, so many different ways to measure it. When you get into different funds that have different religious tilts and different tilts on different countries and they'll weight ESG, different weights depending on what it is. So lots of good stuff there, lots to consider on the impact investing side. And now it's time for our rotating segment. This week, it is From the Field. We're sharing some quick insights from our annual personal finance conference in Charleston. So we've been doing this for a few years, and every year we continue to expand it. It started off with just a reception for some clients, and then went to a one-day conference. If you were to call it that, it was more of an opportunity for us to speak on different types of topics, and our clients absolutely loved it. And then this year we expanded it even further to multiple days and had a lot of great speakers. We had topics related to cryptocurrencies and inflation. We went into things related to concentration risk in the markets. We talked about private equity. We talked about different tax and estate planning considerations. It was awesome. We had a lot of different topics. And what's really neat about it, if you're unfamiliar with how the conference works, is we invite all of our clients out and none of the speakers are pitching anything, which is always something that's been interesting to me because I feel like everyone gets invited to finance conferences or the free steak dinner, and you show up and somebody talks on a PowerPoint deck that they didn't create about the market, and the goal is to just get you to hand over all of your assets for them to manage. And the way we do is everything's internal, so there's no conflicts there of somebody going up there and pitching some real estate syndication for an hour and trying to convince you that they're just telling you about real estate. So that was good. Now, I love the topics, but what we found out last year and what was reiterated this year is, as much as I would love to say that the conference is a success because of all the great presentations that we did, the conference ends up being a success because of the clients who are there and getting to meet each other and have great conversations. We had a panel discussion this year on retirement and some recent retirees coming up and just talking through what are they thinking about, what were they worried about. And that, I think, is immensely valuable because it goes well beyond the Monte Carlo simulations or any of the math behind retirement. It really gets to the difficulty of retirement, which is always the emotional aspect and all of those concerns, whether it be identity or where income's coming from. So it was fantastic. Big thank you to our team and to those who came out and sat on the panel and those who participated, because the clients in the room, for the clients listening out there, I don't think you will realize how interesting your stories are. And everybody has a really interesting story of how they've reached the level of financial independence that they have. And I say that not only a level of financial independence of reaching a point of retirement, but financial independence away from the typical financial models that are out there of an AUM fee or a commissioned product. So what ends up happening is you get a room of 50 plus people who are all handling their own finances and are really interested in finance. And the conversations are just fantastic. And going back to my comment on that one, as much as I would love to say the presentations were great, I think they were. The most exciting part is generally the connections that are made there. And I think that was one of the big takeaways from this year. And we're hoping to extend that even into next year. Next year's conference we're going to do in Asheville, North Carolina, in a similar format with some additional exciting ways for everyone to get together and meet each other and talk finance and retirement and life, all that good stuff, right? Without the limits there. So it should be a lot of fun. It was a lot of fun this year, and we'll have some more announcements about the conference as things get closer. But that's all we have for this week, and thanks for listening. See you next time. Hey, this is Stephan. Thanks for tuning in to the Scholar Advising Podcast. If you have a question you'd like us to tackle in a future episode, just send us an email at podcast@scholarfinancialadvising.com. We'd love to hear from you. Until next time.
Scholar Advising is an independent, fee-only financial advisory firm focused on providing hourly financial advice. The information provided in this podcast is for general informational and educational purposes only, and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your financial situation, objectives, and risk tolerance. Thanks for listening.